Am I the only one that didn't know the Federal Reserve has been shaping our economy for over a century? The year is 1913. Picture America on the brink of economic chaos. Bank panics are rampant, money is scarce, businesses are struggling. Enter the Federal Reserve, created to stabilize the nation's finances. This powerful institution, often called the Fed, acts as America's central bank. Its mission? To keep the U.S. economy humming along smoothly. But how exactly does it wield such influence? The Fed's power lies in its ability to control the flow of money. Think of it like the economy's circulatory system. Just as our bodies need a healthy blood flow, the economy needs a steady supply of money to function properly. If you found this intriguing, don't forget to like, subscribe, and share the Finance Arcana YouTube channel with your friends. Also, if you stay till the end of this video, we will share with you some bonus tips on how you can profit from the stock market based on announcements from the Federal Reserve. One of the Fed's primary tools is its control over the money supply. This means it can increase or decrease the amount of money circulating in the economy. How? Through methods like buying and selling government bonds. When the Fed buys bonds, it injects money into the system. This makes borrowing cheaper, encouraging businesses to invest and consumers to spend. Conversely, selling bonds soaks up money, slowing down the economy. But it's not just about the quantity of money, it's also about its price, which brings us to interest rates. Interest rates are the lifeblood of borrowing and lending. The Fed sets a key interest rate called the federal funds rate, influencing all other rates in the economy. Lower rates make borrowing cheaper, stimulating economic activity. Higher rates do the opposite, curbing inflation. Think of it like a seesaw. When the economy slows down, the Fed lowers rates to give it a boost. When inflation rears its ugly head, the Fed raises rates to cool things down. The Fed's decisions on interest rates and the money supply send ripples through the entire economy, impacting everything from mortgages to stock prices. One of the Fed's biggest challenges is keeping inflation in check. This task is far from simple and requires a delicate balancing act. The Federal Reserve, often referred to as the Fed, has to navigate through a complex economic landscape to maintain stability. Inflation is a general rise in prices which erodes the purchasing power of your money. When prices go up, each dollar buys fewer goods and services, making everyday life more expensive for everyone. Remember the saying, "A dollar today is worth more than a dollar tomorrow?" This is because inflation reduces the value of money over time. As prices increase, the real value of your savings diminishes. That's the danger of inflation. If left unchecked, it can spiral out of control, leading to economic instability and hardship for many. The Fed aims for a Goldilocks level of inflation, not too high, not too low. This ideal level is around 2% per year, which is considered healthy for economic growth. Why? Because a little inflation is actually a sign of a healthy economy. It indicates that demand for goods and services is strong, which encourages businesses to invest and expand. It encourages spending and investment. When people expect prices to rise, they are more likely to make purchases sooner rather than later, which stimulates economic activity. But too much inflation can be devastating, as we saw in the 1970s. During that time, inflation rates soared, leading to a period of economic turmoil known as stagflation. The Fed's actions have real-world consequences, and its history is marked by both successes and failures in its fight against inflation. Each decision made by the Fed can have a profound impact on the economy, affecting everything from interest rates to employment levels. Section 5. Crisis Control, the Fed in Times of Trouble. The Federal Reserve, often referred to simply as the Fed, plays a crucial role in times of economic crisis. Its actions can determine the course of the economy, influencing everything from employment rates to the stability of financial markets. Remember the 2008 financial meltdown? It was a time of unprecedented economic turmoil, with banks failing and markets in freefall. The Fed stepped in as a lender of last resort, providing trillions of dollars to stabilize the financial system. Under the leadership of then Federal Reserve Chair Ben Bernanke, the Fed took extraordinary measures to prevent a complete collapse of the financial system. These actions included slashing interest rates and implementing quantitative easing, a policy of purchasing large amounts of financial assets to inject liquidity into the economy. Similarly, during the COVID-19 pandemic, the Fed, under the leadership of Jerome Powell, slashed interest rates to near zero, and launched massive bond buying programs to keep the economy afloat. These measures were aimed at ensuring that businesses could continue to operate and that individuals could access credit during a time of widespread uncertainty and economic shutdowns. These extraordinary measures highlight the Fed's power and its responsibility to act as a backstop during turbulent times. The Fed's actions are not without controversy, as some argue that such interventions can lead to long-term economic distortions. However, in moments of crisis, the Fed's ability to act swiftly and decisively is crucial for maintaining economic stability. The Fed's actions during crises can have lasting impacts on the economy, influencing everything from interest rates to the value of the dollar. By managing monetary policy and acting as a lender of last resort, the Fed aims to mitigate the effects of economic downturns and support a stable financial system. Its role is a testament to the importance of having a central bank that can respond to emergencies with both speed and precision. Section 6. The Fed and you making sense of market signals. Understanding the Fed's actions is like having a secret decoder ring for the financial markets. The Federal Reserve, often referred to simply as the Fed, plays a crucial role in the economy. Its decisions can influence everything from interest rates to employment levels. By decoding the Fed's signals, you can gain insights into the broader economic landscape. When the Fed speaks, Wall Street listens, and so should you. The Fed's announcements can cause immediate reactions in the stock market, affecting the value of your investments. Traders and investors closely monitor these signals to adjust their strategies accordingly. By paying attention to the Fed's announcements and policy changes, you can anticipate market movements and make more informed financial decisions. For instance, if the Fed hints at tightening monetary policy, it might be a signal that borrowing costs will rise, which could impact your personal finances. For example, if the Fed signals that it's going to raise interest rates, you might want to reconsider taking out a variable rate loan. Higher interest rates mean higher monthly payments, which can strain your budget. Why? Because your borrowing costs could increase. This is especially important for those with existing variable rate loans, as their payments could rise unexpectedly. Understanding these signals can help you plan better and avoid financial pitfalls. Keeping an eye on the Fed's actions can give you a leg up in the financial world, helping you make smarter investment and savings decisions. By staying informed, you can adjust your investment portfolio to mitigate risks and capitalize on opportunities. Whether you're a seasoned investor or just starting out, understanding the Fed's signals can be a valuable tool in navigating the complex world of finance. Section 7. Investing wisely. Riding the Fed's waves. Savvy investors know that the Fed's actions can create opportunities in the stock market. When the Fed lowers interest rates, it can boost stock prices by making borrowing cheaper for companies. Conversely, when the Fed raises rates, it can put downward pressure on stocks. But it's not just about interest rates. The Fed's commentary on the economy can also move markets. If the Fed expresses confidence in the economy's future, it can boost investor sentiment and drive stock prices higher. By understanding how the Fed's actions can impact different asset classes, you can position your portfolio to potentially benefit from its moves. Section 8. The Future of Money. Crypto and the Fed's evolving role. The rise of cryptocurrencies like Bitcoin has presented new challenges and opportunities for the Fed. Cryptocurrencies operate independently of central banks, challenging the traditional role of institutions like the Fed. The Fed is closely studying the implications of digital currencies, including the potential for central bank-issued digital currencies, or CBDCs. How the Fed adapts to the evolving financial landscape will shape the future of money and payments. The Fed's role in the digital age is still being written, but one thing is certain: its decisions will continue to impact our financial lives. Section 9. Stay informed, stay ahead, your financial future. The Federal Reserve may seem like a distant, powerful entity, but its actions have a direct impact on your financial well-being. By understanding the basics of how the Fed operates, you can make more informed decisions about your money. Stay informed about the Fed's announcements, follow financial news, and don't be afraid to ask questions. The more you know about the Fed, the better equipped you'll be to navigate the complexities of the financial world. Remember, knowledge is power, especially when it comes to your finances. Bonus tip: Congrats on staying till the end of this video. One key way to profit from the Federal Reserve's announcements is by paying close attention to interest rate changes. These announcements can significantly impact stock market trends, offering opportunities for savvy investors. As we mentioned earlier, in times when the interest rates are low, finance and tech stocks will rally. When interest rates are high, traditional company stocks will rally. Remember to spend time thinking about what the US Fed is doing at any point in time, whether it is injecting capital into the system or withdrawing capital from the system before making large investment moves on your part. Don't forget to like, subscribe, and share the Finance Arcana YouTube channel with your friends to stay updated with more financial insights.